If you are an investor in the Singapore market or just someone trying to keep their head above water in this economy, you have probably seen the headline. It is the kind of headline that makes you stop scrolling and start worrying. Bankruptcy orders in Singapore have just hit a 5-year high. We are looking at 1,195 bankruptcy orders in just the first 10 months of 2025. That is a staggering number. If you are sitting there with a mortgage, a car loan, or a small business, that number looks like a warning shot. It looks like the system is cracking. It looks like the financial ruin we have been fearing is finally here. But if you strip away the panic and look at the raw data, the story is not quite what you think it is. In fact, if you look at the details, this isn't just a story about financial collapse. It is a story about a strategic reset. The headline number of 1,395 is real. But the reason behind it is not what the tabloids are telling you. This isn't just about people buying luxury watches they can't afford. It is a much more complex and, frankly, a much more actionable story for us as investors. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, point by point, through the real data behind Singapore's bankruptcy surge. First, let's look at the raw numbers, because the numbers tell a story we cannot ignore. In the first half of 2024, we saw 2,034 individuals file for bankruptcy. That was a 25% jump compared to the same period in 2023. By the time we look at the consolidated data for the first 10 months of 2025, we are seeing those orders finalized at that 5-year high I mentioned earlier. Now, on the surface, this looks like a disaster. It looks like the post-pandemic economic stabilization has come with a very heavy price tag, driven by inflation and the cost of debt. But here is where we need to apply the Iggy perspective. Do not just glaze over the difference between applications and orders made. This is critical. An application is when someone, either a creditor or the debtor themselves, asks the court to declare bankruptcy. An order is when the court actually bangs the gavel and says, yes, you are bankrupt. The gap between those two numbers often represents the debt repayment scheme, or DRS. The DRS is a pre-bankruptcy intervention that filters people out before they hit full insolvency. Here is the insight that most people miss. The fact that orders made are hitting a 5-year high suggests that more people are failing the DRS eligibility. To qualify for DRS, your unsecured debts usually need to be under 150,000 Singapore dollars. If more people are bypassing the DRS and going straight to full bankruptcy orders, it implies that the average distress ticket size is growing. People aren't just failing for $50,000 anymore. They are failing for amounts significantly higher than that $150,000 threshold. This tells us the distress is moving up the food chain. It's not just the lower income bracket, it's the middle class and the business owners who are getting hit with larger liabilities. This leads us to the second and perhaps most important point of this analysis. What is pushing Singaporeans to the edge? There is this lazy narrative out there that bankruptcies are caused by young people buying luxury bags or influencers maxing out credit cards for vacations. That is statistically lazy and it is wrong. The data paints a completely different picture. Slightly over 40% of bankruptcy orders in the first half of 2024 were due to business failures. Let me repeat that, 40%. This is the counterintuitive angle that you need to understand. The stress isn't primarily consumer consumption, it is entrepreneurial capitulation. We have lived through a period of historically high capital costs, supply chain disruptions, and severe labor shortages. These factors have squeezed margins until they broke. For us as Singapore investors, this is exactly what you want to see, or rather what you need to watch out for. This 41% figure is a flashing amber light for Singapore banks' SME loan books. We love our local banks, DBS, UOB, OCBC. They are well-capitalized fortresses. But this metric tells me the real economy on the ground, the contractors, the F&B owners, the small traders, is hurting. If you are holding extensive exposure to commercial REITs with non-blue chip tenants, you need to check your occupancy risks. When small businesses fail, they stop paying rent and they default on loans. That is the ripple effect we need to be monitoring. Now, let's contrast that with credit card debt. Credit card debt only accounted for about 18% of the cases. Yes, 25% per annum interest is a killer, but it is not the primary driver of this surge. Personal loans accounted for about 15% and licensed money lenders were around 10%. So, when you see these bankruptcy numbers, don't think shopaholic, think struggling business owner. However, there is a silver lining here, and it comes down to the legal framework. This is where we talk about the strategic reset. If you went bankrupt in Singapore before 2016, you were essentially in a financial prison with an indefinite sentence. I know people who remained bankrupt for 20 to 30 years. It was a black mark that never went away. But the Bankruptcy Amendment Bill of 2015 changed this completely. It introduced what we call a rehabilitative regime. Under this new system, your discharge from bankruptcy isn't based on the whim of a creditor. It is based on a target contribution. This is a fixed sum you must pay, determined by your earning potential. Let's break down how this works, because it is purely mathematical. If you are earning your first $10,000 a month, your contribution rate is set. With dependents, it might be around 10.3%. Without dependents, it's closer to 5.15%. You pay this for 52 months. Once you hit that target contribution, which usually takes 3 to 7 years, you are out. You are discharged. This modern framework offers certainty. It transforms bankruptcy from a black hole into a calculated financial tunnel. You know exactly how long the tunnel is, and you know exactly how much it costs to get to the light at the end. There are effectively 5 pathways out of bankruptcy now, and understanding them is crucial. The first is paying off all debts immediately. That gets you an annulment, which is the best case scenario because it wipes the record clean. The second is a proposal with a 100% creditor agreement. The third is a proposal with 75% agreement. The fourth is the official assignee certificate, which happens when you hit that target contribution I just mentioned. And the fifth is a court order, which is usually for cases dragging on over 5 years. Here's my perspective on this. The annulment is the holy grail. Unlike a discharge, an annulment wipes the record as if the bankruptcy never happened. If you are ever in a position where you are helping a family member navigate this, or if you are navigating it yourself, the goal should always be to negotiate a composition with creditors for an annulment, not just a discharge. A discharge leaves a mark. An annulment erases history. That distinction preserves your credit score timeline significantly. Now, let's talk about rebuilding. Because many people fear that bankruptcy is a permanent stain. It isn't. The system is designed to reward cooperation. If you pay your target contribution, your name is removed from public records 5 years after discharge. However, if you fail to pay it, you stay on the record permanently. It is a very clear carrot and stick approach. From a credit rebuilding standpoint, there is a roadmap. In the immediate phase, the first 0 to 6 months, your score is effectively frozen. You focus on fixing errors and budgeting. In the short term, 6 to 18 months, you can look at secured credit cards backed by fixed deposits to get small positive pings on your credit report. By the medium term, 18 to 36 months, you diversify credit types. And in the long term, 3 to 5 years, you can apply for unsecured credit and return to investable status. This roadmap highlights an arbitrage opportunity in human capital. A discharged bankrupt who has successfully navigated the 5-year slog often emerges with better financial discipline than the average consumer. For employers listening to this, do not automatically discard candidates with a discharge record. You might be hiring someone who has just completed the most rigorous financial boot camp in existence. They have learned the hard way how to manage cash flow. And that is a skill that is hard to teach. So, where does this leave us? How do we summarize this situation? And what is the verdict for you as an investor? Let's look at what is working. The balance sheet of the legal system is working. The 2016 framework is doing exactly what it was designed to do. It is processing failure efficiently. It is allowing risk takers who failed, the entrepreneurs, to reset and eventually contribute to the economy again. It prevents a zombie class of permanently bankrupt citizens. That is a net positive for Singapore's long-term economic dynamism. But let's look at what is not working. The risks are real. The fact that 41% of these cases are business failures is the real headwind we need to watch. It tells us that the high interest rate environment is still biting. We are seeing margin compression in the real economy. While the headlines focus on AI and tech stocks, the brick and mortar businesses in Singapore are fighting for survival. This creates a drag on rental income for commercial landlords and poses a potential risk for loan impairments at the banks. In terms of valuation, we aren't valuing a stock here, but we are valuing the risk in the market. The yield on risk-taking right now is low. If you start a business today, the hurdle rate is high. The cost of failure is being processed efficiently, but the probability of failure remains elevated due to macro conditions. So here is my final recommendation. For existing unit holders in the Singapore Inca economy, meaning business owners and entrepreneurs, hold the line but prioritize liquidity. Cash flow is king. The insolvency numbers prove that profitability without liquidity is fatal. You can be profitable on paper, but if you can't service your debt today, you are out of the game. Check your exposure. If you are drowning, use the tools available. The debt repayment scheme or structured bankruptcy is better than bleeding out to moneylenders. Do not let pride prevent you from using the legal tools designed to save you. For new buyers, meaning investors looking at the market, wait and watch the banks and the REITs. I would not be rushing to buy into small cap commercial REITs that have high exposure to SME tenants right now. The risk reward isn't there yet. I'd wait for a price that factors in a higher default rate. Watch the non-performing loan ratios of the local banks in the next 2 quarters. If they stay stable, then we are in the clear. If they start to tick up, that 41% business failure statistic is bleeding into the public markets. This is a complex story, but it is one we can navigate if we stay rational. If you found this deep dive valuable and you want to stay ahead of these macro trends, consider becoming a free or paid subscriber to our Substack newsletter. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching, and I'll see you in the next analysis.